We've been discussing the steps for auditing the purchasing process. In the last video, we discussed the first step, understanding how a company's purchasing process works. Remember, it all starts with a purchase requisition. Goods or services are requested, then the company purchases those goods or services. The goods or services are received, the company gets an invoice, the company disperses cash to pay the vendor, and the accounting records are updated. So we have covered step one. In this video, we're going to focus on step two, identifying significant accounts and relevant assertions. This is very important to performing the audit. The auditor needs to know which accounts to focus on. So what is a significant account? Well, an account is significant if there's a reasonable chance it could contain a material misstatement. When it comes to the purchasing process, almost always the most significant account is going to be accounts payable. For some companies, accrued expenses, which is a liability, that will also be a significant account, and many of the expenses that appear on the income statement. And the reason these expenses would be important is because a lot of times when there is a purchase and accounts payable goes up, a lot of times there is an associated expense, right? You're crediting accounts payable, you're also debiting an expense account. In this video, I'm just going to focus on accounts payable and transactions that affect accounts payable, but bear in mind in an actual audit, you might also be focusing on things like accrued expenses as well. Okay, so I said not just accounts payable, but transactions that affect accounts payable. So what are the transactions that affect accounts payable? Well, when you make a purchase, right? So if you acquire goods or services on credit, accounts payable is going to go up. But then later, at a later point, you pay off that debt, those liabilities, right? You pay the vendor. You bought something from them on credit. At some point later, you give them cash to pay them. So cash disbursement transactions are going to be important. And then also a third type of transaction that can affect accounts payable is purchase return. So the company bought something from a vendor and then decides at some point we're going to return that. For a lot of companies, purchase returns are immaterial, okay? So they're not significant enough that you would be focusing on them to a significant extent during the audit. So I'm gonna talk about primarily in this video, we're gonna talk about accounts payable and then the two transactions that are most important, purchases and cash disbursement transactions, okay? We're gonna talk about that in this video and in the videos to come. So, when we think about accounts payable and these transactions, we've identified this is important, right? This is the crux of our audit is accounts payable and then thinking about purchase transactions and cash disbursement transactions. Now that we know that, we've identified these significant accounts and transactions, now what do? We need to look at the relevant assertions. When it comes to accounts payable, management is making assertions about existence, completeness, cutoff, valuation, and classification. Now that's a lot to take in, so let's discuss each of these individually. And we'll start with one of the most important assertions for the purchasing process, which is completeness. Now why is completeness so important? It's because management has a very strong incentive to understate their liabilities. Think about it. If you're going to a bank to borrow money to try and get a house, do you want the bank to know that you have $200,000 of student loans and $50,000 of credit card debt? Probably not. Similarly, companies would like to understate how much debt they have. They don't want investors to know how many liabilities they have. Okay, so in some cases, they will understate their liabilities. So it is the auditor's job to make sure that when management says, oh, yeah, we have $200 million of accounts payable here, and that, yeah, this is complete. That's all our liabilities. It's the auditor's job to go and see, okay, is that assertion correct? Or do they have more than $200 million in accounts payable? Maybe management has understated the liabilities. Okay, so completeness is very, very important. The existence assertion is not quite as important because if you think about it conceptually, why would a company say they have more liabilities than what they actually have? Would they make up, for example, and say, you know what, actually, we have $800 million in accounts payable. And in reality, they only have $200 million. And you say, why would they overstate this and say, yeah, we have an extra $600 million in debt. We're fooling everybody into thinking we have more debt than we actually have. Okay, so they're not going to lie generally and say they have more liabilities than what they have. So generally, the auditor is not worried as much about existence of, oh, do those liabilities really exist? They're more thinking, oh, has the company told me about all the liabilities? However, I still have existence assertion up here because it is important to the extent that the company's employees might commit fraud. For example, setting up a fictitious vendor, okay, or setting up or somehow getting the company to try and pay for personal expenses of that employee. So it might be the case that there's a liability that is not a true liability of the company, and it's actually it's something that has to do with an employee of the company committing fraud. Okay, so that's why existence is up there as a relevant assertion. It's just not as important as completeness when we're talking about the purchasing process. Now, the cutoff assertion is very important because sometimes, so let's say the fiscal year end for a company is December 31st, and the company gets a bill on December 31st, and they say, okay, you know, we actually should be recording this liability today on December 31st, but the manager says, you know what, actually, I'm not gonna tell anybody about this liability. I'm just gonna lock it in the drawer of my office desk, and then on January 1st or January 2nd, then I will report this liability, because then the fiscal year ended December 31st, that liability won't be included on that balance sheet as of December 31st, right? So that's the issue with cutoff, is that management would be trying to postpone a liability into a future period. So they don't have to record it today, we'll push it into a future period. Now, valuation has to do with company basically understating the amount that they actually owe. Maybe a particular vendor, they admit that they owe a vendor money, but they say that they owe them a lot less than what they actually do. In some cases, you might have the going the other way, where the vendor is saying that the company owes more than what the company actually owes. So classification could be an issue. If we think about the expenses that are associated with accounts payable, remember I said when a company's recording accounts payable, they're crediting accounts payable, sometimes they're debiting an expense. So those expenses, maybe there's something that the company records as an asset when it actually should have been expensed immediately, right? So there might be some misclassification there, or maybe a company is recording something as a short-term liability, or excuse me, as a long-term liability when actually it should be short-term. So that's the classification assertion it can be important. Now, we also need to look at assertions, not just, so those were assertions for accounts payable, but then remember I said there are important transactions that affect accounts payable. I talked about purchase transactions, and then I talked about cash disbursement transactions, okay? So for example, I won't go through all of these, but for example, with purchase transactions, management is asserting that this purchase actually occurred. Again, generally, management isn't going to be trying to overstate how many purchases and liabilities they have. But again, there could be an issue with employee fraud, or something like that, where maybe there was a purchase recorded, but then there were no goods or service received. Maybe it had something to do with one of the company's employees stealing from the company. So we will discuss all this in the next video. We're going to be talking about the risk of material misstatement right here. Okay, and then we'll be getting into evaluating the design of internal controls, testing the effectiveness of those controls, and then performing substantive procedures for the purchasing process.